Guys, the stock market has been having a pretty nice rally since that bad CPI report. And many times when the stock market acts good on bad news, that's usually a sign of a pretty good reversal. However, I'm not so sure that that's the case here. And so even though the S&P 500 and the Nasdaq are up probably 8% or so from the bottom, I still think that this is a bear market rally and we haven't seen real capitulation yet. So let's take a look at what's going on in the economy with the housing market, the recession, and where we are on the capitulation scale. So usually housing takes a while to react to a weakening economy. And here they say US homebuilder confidence now collapses in October and future sales hope hits decade lows. And normally home builder confidence goes with home buyer confidence, but here is a divergence. While home buyer confidence has been going down, especially since interest rates have been climbing in the last 6 months or so, home builder confidence has been going up until it doesn't. And now it's starting to try to catch up to where home buyer confidence is. And this is a graph of home builders, prospective buyers, present sales, and future sales. And you see they are all tanking down to about 2012 lows right here. And even though we've had 2 negative quarters of GDP, which means we're in a recession, everybody still denies it. And Joe Biden says our economy is strong as hell while he ate some ice cream. And the press secretary says economic indicators are not pointing to a recession, but the Bloomberg recession odds indicator, which looks to be pretty accurate. I mean, it went up to 100 in around middle of 2000 or so, around 2008 and in 2020. And now this is not saying we're definitely out of recession. It's only a 99.9915 percent chance, right? So there's still a chance that we're not, according to, I guess, the White House. So there's really a whole lot of information here on this fund manager survey. And so they survey fund managers who have about $1.1 trillion under management. So let's see what some of these charts say. So here's a look at global money market fund flows. And generally, when people get out of stocks, they put their money in money markets to park it there until they want to get back into the stock market. And the level it is at now hasn't been seen since the pandemic lows. And look at the levels it reached during the pandemic. You see that this is what capitulation looks like when everybody is getting out of the stock market because it's too risky and they get into cash. When you see something like this, you will probably believe now that we are at some kind of a bottom. Are we getting there? Possibly. I don't think we're there yet. And so in the fund manager survey, they showed the average cash balance of these fund managers, and October is now higher than any level since 2001, really. And that's their average cash level as a percent of assets under management. So they are raising cash as well. The average is somewhere between 4 and 5%, but they are now above 6%. And this chart shows the percent of these fund managers that are overweight in stocks. And so the light blue line above zero means that 60% were overweight here recently in 2021. Now it's saying that about 50% are underweight in equities. So they are lightening up. And this is the net percent of them expecting a stronger economy in the dark blue line. And this is the S&P 500 year over year return on the right-hand side. So here's the S&P down 20, 25%. And they are no longer expecting a stronger economy. You see that level is something like minus 80%. Compared to just recently, they were plus 80%. And here's a chart of the financial market stability risk indicator. And on the left-hand side, the scale is inverted. So the lower you go, the more risky it is. And you see it is at a level here that is even more riskier than around 2008. And just about a year ago, it was a very low risk level here. And the lighter blue chart is the S&P 500. And so here you see, as the market goes up, they think it's less risky. When the market goes down, they think it's more risky. Except here where the indicator went down quicker than the S&P 500 return has. And so how are these fund managers invested right now in different sectors? So this shows their positioning versus historically how they are positioned. And so it shows that they are overweight in cash, utilities, staple, healthcare, commodities, US dollar, energy, and bonds. And they are heavily underweight in equities, British pound, Eurozone, tech, industrials, UK, discretionary, REITs. And what do they think the terminal Fed funds rate will be? Meaning the rate when the Fed will stop raising and actually start thinking about possibly lowering. Well, if you just go back to August, the most likely was between 350 and 3.75, but that has changed. And now in October, the most likely Fed funds terminal rate they're seeing is 4.5 to 5%. That's a big jump in 2 months. And so that's what these investors are hoping for, that we hit a recession. So the Fed has to reverse and start lowering interest rates. And so this is the percentage that say short-term rates will be lower in 12 months. That is now increasing. And the percent that say short-term rates will be higher in 12 months is now decreasing. And so when they were asked how risky they consider different things like emerging market risk, business cycle risk, counterparty risk, geopolitical risk, credit risk, monetary risk, and protectionist risk, it is at the highest level since around 2008. So even though the fund managers look pretty bearish right now, we have had a bounce in the S&P 500 and the QQQ as shown here. Here is a monthly chart of the SPY, a weekly chart, and a daily chart. But let's look at some perspective. Although we've had a nice bounce from 348 to 374, which is probably about 8%, it has not even touched the 50-day exponential moving average. And here on the weekly chart, it has not even gotten close to that. And on a monthly chart, though, this is kind of the make it or break it. And so when a stock is strong, it will bounce off this 50-month exponential moving average at least some percentage and usually continue up. When it's not, it will hit this and just keep falling. And so right now, people are trying to decide, is this a place where we're going to bounce good, or is everybody going to give up pretty soon and blow right through here? So that all of these now turn the shorter term periods, 10 and 20 exponential moving average periods, start going below the 50 period and head into a downtrend like you see here on the weekly chart and here on the daily chart. QQQ is very similar, except that it is a little more negative because it has blown through the 50-month exponential twice already in the last 2 months. And again, this daily chart bounce is nice, but it's not even touching the 50-period exponential moving average yet. So there could be more to this bounce. But again, I don't think we've seen the lows of this downtrend, and I don't think we've seen people capitulate yet. So guys, that's a look at what's going on in the market right now. Can this bounce continue for a while? Of course it could, but like I said, I don't think this is the capitulation bottom that everybody is waiting for to load back up on. And if you want to know what a real bottom feels like, think about what happens in a top. Did you ever have a stock that you were watching and everybody was getting rich on and you couldn't stand it and you just had to get in after a while, like a Tesla or a Bitcoin or something? You kept seeing all these videos and stories of all these people and your friends talking about it, and you just got so angry that you had to put all your money in just because you didn't want to miss the bus. That is usually the top, right? So a bottom is the opposite of that. When you just don't want anything to do with stocks. You want to dump all your stocks because you know that they're all going to zero and you're going to lose everything. and you don't want to keep looking at the losses that you're racking up every day. And so when everybody is kind of thinking that way, that's when you usually have the flush out bottom. And it's usually a pretty big spike down, a lot of volume, a lot of volatility. The VIX index is not anywhere near the spike bottom VIX indexes we've had in past bottoms. So keep an eye on the VIX and keep an eye on the consensus. If people are still talking about catching the bottom, buying the dip, this and that, we're probably not at a bottom. When people are saying, I don't want to talk about stocks anymore, let's talk about something else, that's probably the bottom. I hope you like this one, guys. I'll see you in the next one. Thanks for watching.